Let me just introduce, hopefully, we did this right. Ladies and gentlemen, boys and girls, welcome to the very next episode of the official Art of Fighting BS podcast. This evening, starring Derek and our very special guest, Andy Meade, who is an expert in financial matters. We'll get into that at some point here in the very near future. So, take it away, Andy. Who are you? What do you know?
Wow. Hi, guys. Quasi-expert in some things. My background's economics. I studied that in undergrad, and I've worked as an economist for one of the big four firms, doing a lot of kind of global valuations, cross-border movements of intellectual property, that sort of thing. So a lot of valuations, a lot of kind of looking at the mechanisms of how funds move back and forth and how we account for all that. So.
All right, so let's cover why we're here tonight. So we're calling this an emergency episode, and obviously, if you woke up this morning and were exposed to any sort of media at all, you know that there is some sort of barn fire going on in the stock market right now. It started as apparently some sort of a movement on Reddit. And maybe Elon Musk was involved, and there's all sorts of confusing terms like short selling and short squeeze, and lots of stuff going on. GameStop, and apparently they're trying to I guess is kind of like a middle finger, just kind of like prop up all of these firms that are publicly traded that are basically over with anyway. So, that's kind of my take from it. I have been looking at it for like a day, and I can't make sense of it. And so that's why we're here to speak this evening.
Nice. Well, you said one thing interesting there already, which is Elon Musk. I mean, Tesla's stock is up 4x just this last year. And his personal net worth is up.
Yep. But he didn't even make earnings, right?
No, that has little to do with it. It's people betting on this. And this is the first thing to understand. Like in theory, in abstract theory, the price of a company's stock by definition reflects investors' expectations of future cash flow from that stock. In theory, if you ran the math, it'd equal out to the penny. In reality, the market treats these things more like prop bets in a casino. And you can make money as the thing moves up or down just on volatility alone, without regard to the underlying asset.
Okay, so jumping in there. So to make it clear, in theory, a stock is basically, I want a piece of the company's future earnings. That's going to be a dividend that the company pays back to me. But in reality, it's, well, this is probably going to pay something much more in the future, so give me money now for it.
It's the difference between what the stock actually returns to shareholders as dividends versus my capital gain or loss on the stock. So if I'm investing in a stock, if I'm putting $100 in, I better be expecting $8 a year in dividends, or else it's not worth me doing it, right? Why am I going to give you $100 unless I get back something like $10 a year into the future?
Most companies don't do dividends, really.
Right. Companies have moved away from this. Amazon, Bezos became the richest guy on earth by just flat out saying, dividends, we're not going to do that. Why would we give cash to anyone except Amazon? Because we actually believe that Amazon having that cash is going to make the most money for Amazon. So they train their investors in Wall Street early to be okay with that and just look at the price of Amazon stock. They realized you can pay out absolutely nothing and tell your investors, just give them the middle finger. They get people on earnings calls all the time pressuring them to pay a dividend, activist investors, and they answer back like, nope, not going to do it. Sell the stock. So that's an option. And that kind of showed a lot of tech firms kind of the way forward, because you can comp your people on capital gains, right? Derek, you work for the company. I can give you stock options that vest and get you these huge returns, but it's not even ordinary income. There's special accounting for these options, right? So it's a way to kind of create value for the stakeholders in the company without actually paying anyone. And there's been fights over that for decades. That's kind of part of this game, is that split between the value of the dividends you get and the amount of money I can extract by just watching the price go up and down in the short term. So call it short-term trading versus long-term trading.
Okay, so the stock market, people trade these little pieces of company back and forth. Now they're not really expecting to get dividends, or just expect.
Hey, audio cut out there.
Oh,
did we lose
no.
Derek? I still see him. Oh, I don't know.
Can you hear me?
There he is.
I don't know.
Yeah,
My
I saw your
AirPods just
thing
cut out.
blinking. You're good.
Yeah, that was weird.
See, now you have to charge each one separately.
Oh, technology. I hate technology. I really do. I was on the computer so much as a kid, but I can't stand it anymore. I don't know what happened. I'm not even old.
Silicon Valley happened.
Okay, so sorry. Back on topic. GameStop, right? It's being on the verge of bankruptcy for.
Yeah.
Happening now. Why is there?
Derek, you may want to just go direct device audio.
What's happening?
You're fading in and out pretty hard.
I'm gonna grab it. Let me see if I can find some plugs.
Let's keep running with it.
Okay. Basically, trying to get back to the point that I've been trying to get to. What's going on with GameStop now? What these shares? There's not going to be any dividends because the company's going bankrupt. Why is the stock up over $500?
Right. So, do you guys know what pink sheet stocks are? Is that a common term people use?
Yeah, so pink sheets are, you're not listed on a major exchange anymore because your price per share, I think, is lower than what they'll actually list. Is that
absolutely right?
Yeah,
That's
okay. I got one right.
It's for 400, Alex.
Yeah, dude.
Yeah. So when a company falls below a threshold, with the Nasdaq, it's $1 a share. If you're below that, you're considered a penny stock, and they delist you, which is basically death. GameStop's not there, but it's on that spectrum. It's not doing great, and it's simply that people don't buy video games at brick and mortar stores in plastic containers anymore. There's this thing called Steam, so it doesn't make a lot of sense as a business. And finance nerds have kind of called these firms zombie firms, which is a firm that doesn't really have a good justification for existing. You couldn't go to investors today and be like, I got a great idea. I'm going to rent retail spaces in front of Home Depots and sell video games in boxes. They're just going to look at you like you're crazy. But when you're a big company and you have all this historical inertia, you have all these workers in place, you have all these buildings, all these leases signed, you kind of just keep limping along. And that's kind of where GameStop is. It's a zombie firm. What the issue here, though, is that this firm has all this stock outstanding, and people can trade on it whether or not they care about the future of selling games in boxes at retail stores. And actually, this is a critical distinction people don't tend to think about. The stock these firms print basically, is really basically a form of a currency. It's not US dollars, it's not yen. And it's not a blockchain currency. It's a stock certificate, but it has the same function. When people agree that this thing has value, and they're willing to exchange it for other currencies that people agree have value, it gains value in the eyes of the market. And so, what's new here with GameStop is you actually have the general public getting wise and saying, wait, so there's all these little currencies out here, right? Not the yen or the dollar, where the volumes are so high that you couldn't move the yen if you tried. It would take hundreds of billions of dollars. But with something like GameStop that no one's particularly interested in, they printed all. I mean, they authorize shares in the terms of 10 million shares or 100 million. So there's a lot of shares. They have a decent value. They're not a penny stock at all. So they're public listed, so we could just buy and sell them. And investors looking for short-term profits are way more interested in the capital gains they can get by betting on these upward and downward pricing movements than anyone is about waiting around for 15 years holding the stock like an old-fashioned investor, where you just I bought this railroad and now it pays me an 8% coupon every year. Those days are gone. Now I want to make money today.
So they look at it and say, where do I think the stock is going to be tomorrow, and price it off of that versus what the future expectations of earnings would be.
If I know the price of a stock tomorrow or even 20 minutes from now, and I have enough leverage, I can make serious money. And that's the seductive thing. And so what's changed now, because Wall Street's been doing this forever. What's changed now is that you have all these people home for COVID. They all have these little computers in their pockets, and the computers all have basically a Bloomberg terminal now with zero cost, zero fee brokerage accounts in their pocket. So
what is a Bloomberg terminal?
Bloomberg terminal was this thing Michael Bloomberg came up with in the late 70s, early 80s that allowed Wall Street investors to tap into these what were these giant mainframes, these IBM mainframes. They could tap in from their house and see stock prices.
We used to have a Bloomberg feed where I used to work, and it was actually almost like a separate internet connection that came in that would give us access to stock tickers and stuff like that. So it was, pretty, I don't know, forward.
It gives you root access. You can execute live trades. So we had them at I went to University of Washington. They donated some because just like Apple likes to donate their computers, they want to get people using them. So the finance, major people had like a room of Bloomberg terminals, and you could go and execute trades, mock trades on them. But now that's what Robinhood basically is. They're like, oh, well, we can do that on the app. We no longer need, the thing that made Bloomberg so rich was that they kind of got control back when it still was switchboards and like things plugged into other things, and guys yelling at each other in the streets of New York. Now it's all on the internet. So now you get a thing like Robinhood where they're like, yeah, we'll do that too. There's a zillion no fee trading things. Robinhood's thing was they gamified it. They made it more like Candy Crush, where like you get fireworks when you get something goes right. You start to do the mechanisms behind let's call it gambling addiction. The same thing casinos do for slot machines.
Okay, so circling back to GameStop, you said they're kind of on this trajectory of being this zombie firm. Seems pretty likely that the stock is going to drop. What happened? What did investors do when they saw that, and then how did the internet respond?
So hold on one second. Let me interrupt because I don't want to jump the shark too much because we're talking in terms of things that people may not understand at this point. So I think we need to kind of in my head, and tell me if I'm wrong, but in my head we need to kind of explain what's going on in a way that normal people can understand. And by normal people, I mean me.
So there's a monkey with a bunch of bananas.
Oh, God.
No, I'll tell you what, I think Derek had a good question. What's your question here? Let's keep going down that path.
So
because the clarifying
we talked about all right, so you can buy stock, right, and sit on that stock for years and years and years, and I maybe it's just me, but I think we kind of skipped over options and contract trading and secondary markets and stuff like that. So I think we need to talk about that because one of the things that's going on, like when you talk about shorting a stock, is that you've taken what's called a position, I think, if I'm right, and you have the option to either exercise that position or to sell your position to somebody else. And I think
shorts and options are similar but different.
Correct.
Okay, similar but different. But so and this is exactly why I'm asking the question, right?
Okay, right. So
go for it, Derek.
So a short seller, what they do is they buy a stock. Let's say it's a stock of Apple, one share of Apple, and then they turn around and sell that because they think Apple's stock is going to drop. Let's say they bought a share for $10, sold it for $10, or they borrowed a share, sold it for $10.
There you go.
Then the next day, the stock drops to $5. They buy a stock, give it back to the person they borrowed it from, and they just made $5. Yeah, I'll let Andy explain options because they're a lot more complicated than that.
Well, and that's the salient distinction. So the short, you don't actually own the stock. You are borrowing, or you're actually paying to borrow. So you're leasing the stock. And then you get to go sell it in the market. You're betting it's going to go down, so you sell it right now at what you believe is a higher price, and you pay the owner of the stock so that they get something for giving you the option to do this. And then if the stock, goes down, you get to buy it back at that, at that lower price. So you get the difference.
In the Big Short, it's all that stuff, the premiums that off-brand Batman had to pay for being able to short those funds. That just kept bleeding them dry until it paid off, right?
Christian Bale is a genius and an American hero.
I forgot his name. I honestly did. Just know him as Batman.
So yes, and the irony here, and actually this sets, and we'll get back to like these kind of terms, but this is actually sets up a great kind of irony. In The Big Short, the problem was the exact opposite of what we're dealing with now, where people, no one could see any sense in ever shorting the housing market. There were no shorts. That was the whole point. So these guys went around and was like, can I buy shorts in the housing market? And they were like, how much money have you got? But it was because some of these kind of inside investors had kind of seen the absurdity of it. You got guys like Michael Burry, the Batman, who actually went through and looked and just like, these numbers don't add up. Someone should be betting that these will eventually go down. Whereas here you have the exact opposite. You have Wall Street taking the position of GameStop's got to go down. It's what I'm saying. Like, this is a dead end business. You can't sell boxes of plastic in a brick and mortar like, have you heard of Amazon? Have you heard of Steam? So they're taking the kind of safe, strong play, which is, this thing has to go down. What Reddit, actually, so let's pause there. So let's address your question about like what kind of option, what can we tell people about like options trading generally and just the basic terminology we're using?
Okay, so there's two different types of options, very simplistically. You have a call option and a put option. A call option, I'll let Andy explain because my mind just went blank trying to wrap my head around all that stuff again.
And we can simplify this. The terms don't even matter because what Derek's calling out is that there is a slight difference between a put and a short sale, even though they're both bets that the stock's going to go down. What we need to know, like, we don't need to worry too much about the difference between a short and a put. It kind of has to do with who owns title to the thing and how the contract works. But what we really need to know is that as an investor today, you can open up your Robinhood accounts. And in fact, Robinhood specializes in this, specializes in getting people kind of engaged in these kind of levered trades. All you need to know is that if you have a strong inclination that you know how a stock's going to perform, up or down, you can place that bet. Wall Street will let you place that bet easily. And so like all you have to do is make a bet and say like, yeah, I think GameStop's going to go down or I think it's going to go up. And if you're right, you can make a bunch of money. If you lose, you can lose a bunch of money. And to bring this back to GameStop, the thing that's happening is the losses for I'm going to get this backwards. Again, like this doesn't have to be complicated, but they make it complicated because I think they don't want people understanding how simple this really is. It basically is a casino betting, prop bets. But
so you have the investors who think GameStop's going to go down. They borrow a bunch of shares of GameStop. They pay a fee for the opportunity to whoever owns those shares. They sell them. The price doesn't go down. Why wouldn't the price go down? And how does that affect the investors, the Wall Street investors?
Okay, so in a short sale run, the way this works on Wall Street is can you guys hear me all right? I just dropped my own earbuds off.
Yep.
Okay, and I'm keeping the volume, you guys, low. So normally the way this works is they look at this and say like, okay, like GameStop doesn't have a future. This thing's going to go to zero anyway. Let's just start our short position. So we're just going to sequentially bet that the stock goes down over time. And as the stock goes down, we'll collect money on those bets. The problem here and where it gets interesting is that and that's the market fundamentals. I mean, I'm looking at GameStop's business and like I don't see a future for them. And that, of course, that's not investment advice or legal. Please don't come after me for that. But like a normal person would look at this and say there's no future here. So let's kind of start. Not only I expect people to sell their shares. I would sell my shares, but I expect other people will in the future. So I place that bet. What was interesting here is that the shorts actually ended up exceeding the amount of shares outstanding, which is hilarious. But again, it's just part of the rule set. One of the questions is, well, okay, so I understand why people would bet the stock would go down. That makes sense. But how is it that there can be more shares betting that the stock will go down than there are shares outstanding? And
So
that's, that's kind of just
hey,
Wall
so
Street logic.
let's talk about that real quick. So
Yep.
when you have an IPO, you go public with your company, right?
Yep.
You'll say, hey, we're going to issue 1 million shares,
Yeah.
right? And so that million shares is kind of the finite amount of money that is involved here. So when we talk about shares outstanding or talking about how these positions work, it's all based on, this kind of really limited monetary vessel, right? So maybe you can address that a little bit, because I don't know if anybody really understands that. I certainly don't.
Okay,
Well, and again, like I'm a bit cynical on this. I've been in one part of the space or another for many years now, and you kind of start to realize that there's a lot of doublespeak here. Where do we even start with this? So, I'm sorry. Can you say your question again? Like, I feel like we're getting in circles on this.
I think I know where it's going. So
my question is, what is money?
Now we're getting into it. Okay, that's simpler, and that's kind of where I was going anyway. I think Derek probably saw that coming. So the thing is, money is just a piece of paper where the person who holds it expects to be given something of value from someone who recognizes that thing as having value. And that value can either be based on, well, in the case of US dollars, it's just backed by the faith and credit of the US government, for what that's worth. It's like, well, we just say it has value, therefore it does. If you want to think of dollars, just think of them as a share in the US government that's got a par value of $1 per share, right? That's all it is. It's just a share that's defined as having a value of $1. When Microsoft sells shares, their share price is totally different. Same with Berkshire Hathaway, but like it's the same thing. You float a certain amount of money and say, look, you'll get something if you give me something else for this. You'll be able to trade just like the thing you're giving me. In kind of finance terms, we'd say that money is fungible. Fungible meaning that it can change forms from one to the other, right? I can start with dollars in the morning. I can invest heavily in yen. I can sell the yen and buy euros. I can sell the euros and buy Microsoft stock. I can say, et cetera, right? Like, so money, you can change between all these different forms. It doesn't matter. But at the end of the day, the market with a capital M kind of just agrees that these things have a certain value, which is simply defined as what people are willing to pay for it. That's what people mean by a free market, is that there's no government saying, well, the value of Microsoft is worth $30 a share this year because that's the number Congress can. No, it's just like whatever it's worth to someone, that's what it's worth. That's how a free market works in theory. And we, for the most part, have that, right? We've got some regulation, but there's some rules. But for the most part, it's like, well, the values of all these things float. They're just whatever the traders, however much or little people want it, just basic supply and demand.
All right, so that explains part of it, right? So the other half of my question there is, like, when we're talking about shares outstanding, obviously that is a key metric when you're looking at purchasing a stock or purchasing options on a stock, right? So right. What does that mean? I'm only asking because you brought up that as a term, and I think we should be able to understand that, right?
Right, got it. So if our company, say the three of us have a company and it's got 1 million shares outstanding, right? And we're doing a pretty brisk business, money's coming in, it's going really well. Each shareholder, each one share is entitled to 1/1,000,000th of the net profitability of that business, right? So if revenue goes up and the number of shares stay the same, the share price goes up because those shares are worth more, because they're entitled to more of that money in the future. And again, there's the wrinkle now of, like, you get a lot of firms that just don't promise they're never going to pay a dividend, but the share price keeps going up because investors understand, well, eventually we're going to get paid. Sorry, I feel like we keep dancing around this. It's just that there's a lot of jargon to get through with people. And I'm trying to kind of keep it very simple. Of, like, people can place bets, but the bets don't have anything to do with the value of the underlying asset or the expectation that people are going to get paid back for that in the future. I think the thing I'm really trying to stress is that this is about betting on volatility. And I think that's where we're getting kind of tangled in circles here, is that this is a story about kind of betting on volatility rather than the intrinsic value of the asset.
So
Okay,
that's
so
yeah. I mean, that's probably
yeah,
my
so
fault because we're looking at this from the perspective of like an entire populace that is seeing this as front page news. What's going on with GameStop and now American Airlines and I think a couple of others.
Oh
Um,
yeah, AMC, a bunch of them.
yeah. So, and I think that people just kind of gloss over, like they don't understand what's going on here. So, from my perspective, that was kind of one of the things that I wanted to kind of address here because, an informed populace is obviously going to perform better socially. So that's kind of our mission here. Anyway,
So there's a perverse incentive here, though. Like, if you're a Wall Street trader, do you really want an informed populace that's able to pull off a Reddit GameStop thing?
well,
And the answer is no.
so yeah,
There's a reason they make this stuff sound obscure and complicated.
so yeah,
circling back to the Reddit GameStop thing, before we took
Yes.
the road less traveled, we had firms that took a short position, so they borrowed stock from somebody, paid a lease for the privilege, sold that, and then the stock price didn't go down. Why didn't it go down, and how does that affect the hedge fund managers that took these short positions?
So
this is where
great question.
Sorry, go ahead.
Yeah, sorry. So we're talking about shorts, but we haven't talked. I don't think about short squeeze and what that is, and so that's kind of an important.
That's
concept.
what we're getting into.
Yeah,
that's exactly what he's about to explain.
Okay, so no, this is great. Thank you for the clarification. This helps me keep on track too. So you're in this interesting position where some smart kids some dorks on Reddit basically looked and said, wait a second, so let me get this straight. Like, say this is you and me sitting around like a week ago, and I'm telling you, look, the short bets now exceed the amount of shares of the company outstanding. So the company has 100% shares outstanding. I have no idea what the number is, but there's 100% of shares in the company. The bets against them are now 140% of the shares of the company. But here's the crazy thing.
Would happen. Yep. So the 144%, that would happen. Let's say I buy a share from a short seller, and then I sell that share to another short seller, or I let another short seller borrow it for them to sell. Is that sort of the process through how there could be more bets against a company than stock out in the market?
You've actually reached the limits of my understanding on this. I don't know the answer. I suspect it's much simpler than that. I suspect you simply have a synthetic betting structure where people can just place the bets, and it's not really, there's not a finite limit, because it's not like people physically take possession of these pieces of stock, right? These are just numbers in an Excel sheet or in a database. So I assume I actually don't know the answer to that, but I assume you're simply allowed to bet beyond the outstanding stock, because it is just a bet, and options traders understand they are just placing bets. So you can kind of place them all over them. Then you get into things about, well, what about a negative stock price? But yeah, I actually don't know. It's worth digging into, but for now, let's just kind of go with, there's 100% shares of stock, and there's 140% bets against the shares of stock. Cool.
Yeah. So what happened to all the people betting against GameStop?
So they took the reasonable position, which is this company has no real long-term future prospects. It's going to go down. Let's just slowly start betting on that as it goes down and down and down. I think I'd heard that it got down as low as like $4. Then you have this, and this is where the story gets really juicy. Then a bunch of nerds on Reddit basically look at this and say, well, but Derek, explain something to me. It says that the people with all these short positions, they've extended themselves where they have to buy back the stock at the future price whenever that option expires, right? Maybe in like 30 days or 60 days or 90 days. What if a bunch of us just bought the stock? Just literally, not even an option, just literally bought the stock, or bought call options, right? Betting that the stock's going to go up. And that's kind of what happened. And so the price started going up because people were like, if the price goes up, they have to pay us. And if the price goes to $100, if they bought their option at, $30 or whatever it is, betting that it's going to go down from 30, if the price goes to 100, they have to pay us the difference. But here's how, we'll use loving terms for Reddit. Here's how the crazy kids over at Reddit, who have been like I think these are a lot of overlap. I think there's a Venn diagram with the crypto people. I think they looked at this and said, $100 a share. What about $1,000 a share? I read a thing today saying, what if GameStop goes to 5,000 a share? The question is, the option holder who has the short sale position, there is no cap on how high that stock can go. They're on the hook for the difference. That's the thing that should just detonate people's brains.
They're still making that payment to the actual owner of the stock or the person they borrowed it from too the whole time, right?
They need to give that share of stock back. So say you have one share of GameStop and I come to you and say, hey man, you're not doing anything with this. It's sitting in an account somewhere. Let me I'll pay you. I'll borrow it. I get to go bet on it. And then in 30 days, it's going to be back in your account like nothing happened. And if I can make money on that volatility, good for me. You get a fee either way, right? That seems like a fair deal, right?
Yeah.
And that's what they did. What they knew in the back of their mind but didn't think through clearly was, if for some reason a bunch of nerds on the internet made a mad run to just start buying the stock in ways that don't make good financial sense, right? This is like when the person kind of button mashes in Street Fighter. Like it starts working because you don't know what's happening. They knew this was an outlier possibility, and then it happened. And now they're kind of looking at it and reading these contracts closely and like, oh yeah, if the stock price is $1,000 a share, I have to buy that stock back for $1,000 a share and give it back to Derek now. And if I have 1 million shares of this, well, I'm on the hook for 1 million times 1,000 minus 30, which is like $1 billion. And that's kind of where we are right now. And Reddit's looking at this and like, so let's just keep making the stock go up and up and up. And they're legally required to pay. And that's kind of where we are. And of course, and that's where basically the regulators stepped in and shut down purchasing the stock on these platforms. Everyone's still able to sell their positions, but not buy more stock, because that would just twist the knife into these short sellers even harder.
Do you know who's making the call to, halt the trading on the stock?
I assume it's the SEC. I don't know how that actually works.
I think it's been a couple of people. So I think Robinhood, who we talked about earlier, is a private trading platform, initially said, hey, we're not going to allow any future trades on the stock. And I think some competitors in the industry also followed suit with that, or maybe led the way with that, right?
Yeah, I figured that's how it comes out in the press release. I think the question is how much leaning on them was there in the background and by whom, and we're just not going to know. But I assume there was quite a bit of screaming phone calls and yelling going on the last couple of days. And yeah, basically these platforms have announced like, we're not going to. Okay, enough's enough, guys. Like that this was funny. Stop.
So we had a question in the chat. It was, how about the institutional folks getting jammed? How do these forced buybacks bankrupt the hedge funds? These are funds with billions and billions of dollars.
Right.
One of them got a $3 billion injection from another firm to help keep it up.
So I like that's a great question. That's where I was going next. I think part of how we need to set that up is to talk about what a hedge fund is and what it does.
Great point.
And then, right, so we kind of understand what their leverage or what their skin in the game is before we can start to dissect their actions, right?
There you go. Okay, so a hedge fund, in very simple terms, is a firm that places bets in the market, and it does so in a way where it's constantly hedging itself. And hedging itself means taking the counter bet of its own bet. So, and you can see people do this in a casino or in horse races or in Wall Street or wherever. It's like, okay, I'm going to bet heavily over here, but then if I'm wrong, I also want to have a counterbalancing bet so I don't lose too much, right? And you can weight these portfolios in a lot of different ways, depending on the risk appetite or kind of goals of the investors, right? If the investors want a quick, killer profit in the next 2 years and they'll take unlimited risk, it's like, okay, well, there's one strategy we go to market with. If it's a much more conservative thing, they do a different strategy. But what we mean by a hedge fund is a corporation with a pool of capital, which is placing bets, but in a way that, and I think I see where you're going with this, they're placing unusually big bets in different directions to try to keep this whole seesaw kind of on a wobbling balance. So that the goal is to achieve what's called alpha. Alpha is a return where you didn't risk anything. You just get paid money because you were in the right place at the right time and you didn't even take a risk, right? So if I bet, say I could go to a roulette wheel and bet 500 on red, 500 on black, and if it doesn't land in either one, I get some bonus. This is a hedged play, right? I can't really lose because I'll almost certainly get the thing either way, and sometimes I'll hit this jackpot. And this was kind of the problem with the GameStop thing is Wall Street's running this playbook that they've honed over many, many decades about, and I've learned a lot of this stuff in university and since, like, there's all kinds of strategies for, this is what those guys sit around and do 16 hours a day, 7 days a week. That's what they have these trading algorithms for, these artificial intelligence platforms. So they're running these very sophisticated games. And again, this is why I use the button mashing in Street Fighter as an example. It's just, Reddit was like, yeah, but I'm just going to buy the stock. And Wall Street's answer to that is, but that's insane. You're almost sure to lose money. It's long term, it's going to fail or go down. And they're like, yeah, but I don't care. I just care about the volatility going up. And so we're in this weird kind of vortex where, like, you have all these kind of hedge funds kind of scratching their heads, like we knew you could do that. Hedge funds do that to each other all the time, but we didn't. No one saw Wall Street bets kind of coming.
And all those firms that took short positions are either having to buy these stocks at massively inflated prices to cover their position and return the stock, or they just keep losing more and more as the price keeps going higher and higher.
Right. They saw 30 going to 20. They saw 20 going to 10. They saw 10 going to 4. And they're just like, okay, we're going to keep placing our bets right into bankruptcy. And in fact, the way they could have steered out of this was when the price hit those bottoms, they could have simply exercised their options, collected their winnings for being right so far, and then just walked away and let the company sit at $4 a share until, eventually, they just kind of get delisted. Instead, you got funds that were like, oh, no, we're going to keep betting it under $1. We're going to keep betting it until it gets delisted. And that's kind of where this went. And then at some point, someone was like, well, but again, like, there's more shorts than there are shares. So all we have to do is buy the existing shares. And then you guys are in for more than the shares are worth in the first place. There's your alpha, there's your guaranteed profit, but it's on our end betting against the shorts. And that's why the story, I think, kind of touches a nerve for people, is it kind of flips the script on Wall Street, which is betting on this company dying. And then a bunch of people come out of the woodworks and be like, nope, still alive. I'm not dead.
You said this is something that happens all the time. The firms do this to each other all the time. If anyone who's watched the show Billions, it's dramatized for sure, but You see it all the time. This person's in there, so I'm going to drive the stock price down or up. Heck, I remember.
I hear it's excellent. And yeah,
it's really good.
The Paul Giamatti character is basically coming for Robinhood and Reddit right now.
Yeah, that's pretty fair. Yeah.
But I think the question, and we can get into this at some point. I think the question is there any kind of a case? Because they played this so cleanly. It's like, well, you're betting the stock's going to go down. I bet if enough of us buy it, it'll go up.
Reddit, Wall Street Bets has been pumping and dumping these meme stocks for years. And there was even, we saw, I remember last year in Market Watch, there was an article about hedge fund traders watching Wall Street Bets and just betting against them because, it's just a bunch of dorks on Reddit.
Not sophisticated. It's a Zergling rush.
So why, if this is something that happens all the time, why is everyone freaking out?
Perfect. Okay, because usually it's happening at a vastly smaller scale. Because if you're one of these kind of major funds, like you're not betting on these big volatility swings with penny stocks. You're betting on, just look at the market capitalization of the Fortune 500, right? You're betting on Amazon, Microsoft, Walmart. And they have all these analysts who sit there and spend all this research time saying, like, okay, what's the price of Walmart stock going to be in 30 days, in 90 days, in 180 days? They've got all, just think of all the people sitting in offices in Wall Street all day. They're not all bond traders. That's what they're doing. They're looking at the prices of these things into the future. And all this was just the internet basically as a meme was like, what if we do the irrational thing? It seems like these guys would be caught with their pants down, wouldn't it? And they tried it, and it turns out they're right. And it is pretty funny, actually.
So it is really funny, and that is, I think, one of the most remarkable things about this situation and why it's such a big news story right now is that people had no expectation that this was going to be something that could make a basement dweller like millions of dollars potentially, right?
Right.
So I think
now the secret's out.
Yeah.
This is a new world now.
So a big part of the story, I think, for us at least, is number one, there's issues about legality, but I think that that's pretty well wash, right? So there's issues about, okay, well, how is this going to be regulated going forward, and how the hell did these guys even figure this out, right? Like, if in the history of Wall Street traders they couldn't figure this out, and a couple of basement dorks on the internet figured this out and basically destroyed potentially several companies, right?
Here's a good illustration of this. There's a lot of things that I can do without a law degree. Right, I can go sign to purchase a home. I can write up a contract. There's lots of things I can do without a law degree. There's a lot of things that I could do that aren't quite a crime, but that a lawyer who's kind of in good standing with the bar wouldn't ever think of going near, because they're worried they'd be sanctioned. They worry there's regulators. They have legitimate worries, right? There's a certain professional code of conduct. This is kind of skirting that difference here, where the internet people are like, well, I don't work at Goldman. I don't have the SEC breathing down my neck. They're going to sue me for buying a stock. And enough people kind of realized that was absurd. So they just were like, let's do it. Whereas if a bunch of traders tried to do it, I mean, they'd be arrested because they'd be clearly colluding to, so that's kind of where we're in this wonky gray area where it's like, these are just retail investors. What's new is that it used to be, in kind of databases, we talk about like one-to-one or one-to-many connections. It used to be that the projection of this information way back in the day, like in the Wolf of Wall Street days, is one-to-many, right? The firm makes a bunch of phone calls. It tells you, bro, I've got this great stock. You should buy it. Give me your credit card number and I'll get you in there. What's new now is all the people getting those cold, one, you don't get the cold calls anymore. The math doesn't work. But now all these people who are being propositioned can just talk to each other, be like, wait, what if we bet against all of those guys? What if we just did the irrational thing, but enough of us did it that it throws the money out of the, I think that's it. I think it's that it throws the situation out of the parameters of these really carefully curated and well-guarded Wall Street models. And just, it's just breaking them for the sake of breaking them.
So we had a question in the chat. Now that, these shorts are massively blown out, is there anything that the hedge funds can do to combat the dorks on Reddit?
I'm sure there's all kinds. In what types of ways? Like things they can do within their trades, or like regulatory things?
So I saw, today that the price was dropping, and I was reading that it was just the result of a lot of different hedge funds trading the stock back and forth to try and drive it down.
Right.
What other techniques, if any, could they have to minimize the losses they've gained so far? They've suffered so far.
I think, and I could be wrong, but I think that the price was dropping today because trading was curbed at either a regulatory level or at the level of the individual brokers that were engaging in that. Is that correct?
It's both, actually. You guys are dead on between you. It's both. So yeah, they're trying, and one of the things to keep in mind is there's no such thing as a free market, right? Like, we're acting like this is taking place in a vacuum. The reality is the traders in is it Marvin or Melvin? Melvin. The traders there. I think it was
both,
friends.
Actually, wasn't it?
No, Melvin was the hedge fund that took at least the majority of the shorts.
All right, my bad.
So these guys all know each other. That was the thing. Do you remember watching Margin Call? It was the same story. It's like, well, if we dump bad, toxic assets on our colleagues, we won't have friends anymore. It's like, yeah, these people all know each other. They all went to Harvard and Yale together. It's a very insular club on Wall Street. And so, yeah, like immediately this fund overextends itself. The other firms notice, and they just, without even blinking twice, they just recapitalize them. Like, oh yeah, we'll give you billions more, not a problem. In fact, we see what's going on here. Every one of these firms sees how this is very, very dangerous for them. Because they're now all looking at all their short positions, and they know that people over at Wall Street Bets are doing the same thing. And so suddenly Wall Street can kind of circle the wagons, right? And say like, okay, this stops here. Let's, you go have dinner and with whoever and have the phone calls, but like, let's all agree to kind of sell our stock, unwind our positions, buy more short positions, just kind of throwing their weight around. And the internet is kind of looking at that and be like, oh yeah, why don't you do that? Why don't you buy more short positions? We'll keep buying more stock. And then they were, so it is kind of this arms race thing. And then they respond with, however it happened, these trading platforms have kind of had it made clear to them, I suspect, that it would be in the long-term interest of these trading platforms if they just suspended trading of the stock until Wall Street firms can get a lid back on this thing and kind of cover their other positions. I suspect
So to sum it up, the way that the hedge funds fight back is by insider trading with each other,
colluding,
pressuring the government and the platforms to do what they want to do. That's
hey, what else is new?
Fantastic.
Is anyone surprised by that at this point? That's what they do. That's how you like. This is there's a reason these guys are all in the same Ivy League schools, the same kind of like it's not a conspiracy. It's just it's a group of people who know each other and they like being friends with each other. Like they like cutting each other in on deals. It's not what I think people outside of it picture, which is everyone for themselves. Right. It's a club. That was Carlin's line. It's a big club and you ain't in it. Like that's basically it.
So I want to switch gears. You said earlier, the value of money is fungible.
Yes.
I'm just going to say two words because if anyone's been following the GameStop stuff, they probably also came across Dogecoin. What the hell? I saw like everyone on my Facebook talking about it, so I bought like a few dollars worth, and it's up 100%. I don't even know what it is. I don't know how to spend it. What the hell's going on?
Was the question what does fungible money mean, or is the question what is Dogecoin?
Well, what is Dogecoin? And I guess we talked about this a little bit before we went live about how it relates to things like tulips and gold and Bitcoin in terms of value. And I kind of want to dive into that a little bit.
Well, so let's answer them backwards. Let's start with tulip mania and all that. So the point is people have been making these stock runs forever. I forget the year. Someone can post it in the chat. I'm going to guess like 1617 or something in the Netherlands, right? There was this run on tulip bulbs where suddenly everyone wanted to buy tulip bulbs. And the logic was with tulip bulbs, tulips make more tulip bulbs. So if I have a bunch of bulbs, I can have more bulbs next year and even more bulbs next year. I'll have an infinite amount of tulip bulbs over time.
1637.
Close enough. 20 years. I'll take it.
That's pretty good.
In fact, if you want a number, I think it got to a point where to buy a single tulip bulb in Amsterdam cost more than a fine suit or a good-sized kind of wooden barrel of beer for one bulb. Now, did that make any sense long-term? Like, no. This is just where human minds break when they start seeing infinite value, which is, well, if each tulip bulb makes 3 tulip bulbs each year, then I have a compounding fractal and I'll make infinite money. And it's like, well, not if everyone else is doing it. So you get these runs periodically where people see an opportunity and then they all pile in, and whatever money the original people saw to be gained there is quickly kind of gobbled up and dispersed. And then what you end up with is a lot of people holding the bag, wondering what the hell happened. And that has played out this really is, I hate when people talk about human nature, but that really is one of those things that seems to be kind of human nature. But I will caveat this and say kind of human nature within a competitive market economy. When people are looking for like, if I can just get in there early enough, it's seductive. If I can just get in there and time it right, I can, I'll never have to worry about my student loans again. And so people kind of pile in. And you get this kind of, you get this kind of YOLO mentality where it's like, well, it's $1,000. If it turns into 5, great. These people are the opposite of sophisticated investors. It is actually their, I'll put it that way, with some love. It is their lack of sophistication and being willing to do these basically financially irrational plays that has kind of confused, it'd be like if you're playing against a pro soccer team and all your guys are running backwards. It's like, that's not a good strategy, but you could see how you could get a goal out of that. It just confuses them.
That happened on Ted Lasso's an Apple TV show about yeah, it was an
I know
American
who that is. I saw the trailer.
Oh, it's so funny. It's so good. But he did a game where all his players did trick plays, and the other team was like, they lost, but the other team was like, I don't know what the fuck to do with this.
There was a guy, and I think it was like Palo Alto or something. He coached high school girls basketball, and he started running an aggressive full court press on every single play with girls who are not great ball handlers. This would never work in the NBA. You'd never do a full court press on every play. Your people are going to be exhausted, and they'll just lob the ball over your head. But at that level, it worked, and he was getting scores of like 100-5. And they eventually, the other parents and league people were like, "This is ridiculous. You can't do this." And he was like, "Hey, my team's winning." So you get these kind of interesting plays where people find a hack it's not a good strategy if you're playing the game quote unquote well. But if the other team is only used to playing the game quote unquote well, and then someone does something that doesn't make sense, there's a temporary competitive advantage created, right?
Temporary.
So that's kind of what, right.
What does the rebound look like? Because, eventually people are going to figure out.
Gonna fall. The people holding the stock are going to lose money. GameStop let's rewind the clock to a couple months ago. GameStop stock was kind of worth what it was worth. If anyone wanted to buy it, they could have. It was worth $10 a share or whatever it is. Now it's worth, like $250 or something as of today. So all those people who bought in, that means people are buying in at $250, and they're going to get back like 10. Someone's got to lose for every dollar that's being made there. We're not actually creating wealth here. We're just squabbling over the pie.
So somebody eventually they're going to have to sell. If you bought in at $4 and it's $250 and you don't sell, you're absolutely insane. What does that do to the price of the stock when people start selling?
It'll collapse immediately.
Because I listed at $250, somebody else wants to list it, they do it at $249, so on and so forth, until you get people who are actually trying to buy it for the value.
Oh yeah, it'll go back down to whatever it was. This really is one of those one-off unique events. But again, and we kind of started with a good set of distinctions about this. The people betting right now on the call options don't really care about that. They know the long-term future value of the prospects of the stock are straight down at this point, but they don't care because they care about the volatility over the next 72 hours.
Pause real quick. So just to explain what options are, because I don't think we got into that earlier. Right. Options are a bet on whether the price of the stock goes up or down. You don't actually buy the stock or sell the stock. You just buy the right to do something with the stock, depending on whether it goes up or down. The value of the right to do that thing with the stock, the value of that also has its own market. And when the stock's price is volatile, people don't know what to do. The price of those option contracts goes up. So people can buy a call option, betting that the price is going to go up, knowing that it's not really going to, but just expecting that the volatility will make somebody else want to buy it even more down the road.
I don't know if I'm going with you on all of that. Let's backtrack to the last couple sentences there. So let's just make a distinction, right? Imagine let's say you're entering a horse into a horse race, right? And there's a prize purse if you win. So you actually own the horse. You're going to enter it in the race. If your horse wins, you get a huge payout. I don't own a horse. I'm just betting on your horse. And I could actually stand to, do you see how I could make more money off of your horse winning than in theory you could win off of the prize purse to begin with?
I don't have to pay for the upkeep of the horse and the hay and the getting it.
Well, you actually do in this example. I don't. I'm just placing speculative bets. But here's the other thing. Your prize purse, here's the distinction. Your prize purse is fixed. It's $10,000 or whatever it is. But if I can create a market and I can get my buddies to float me for $1 million bet on your horse, I can place that bet. And to give it kind of an illustration of hedge funds, what they're doing is, let's say they're doing this thing where they place 10,000 bets on every horse, but with like subtle adjustments between those bets where it's not exactly 10,000 for each one. There's some AI system that spits out, you want to bet 9,500 points on horse A, 10,200 on, etc. So tons of bets, tons of little, what for them is little bets. And then but what they're optimizing for is all possible outcomes. They're not really gambling. They're trying to kind of map the overall risk of the race itself. And so that's where, yep.
Yeah, so right. So, and I kind of want to bring this up earlier because I don't think it's a term that we've gone over yet, but we call that covering, right? So basically you're saying, all right, well, I could lose $1,000 here, but I'll make 950 on the other side of it. So, my loss is, minimized or covered.
Yeah, covering or collaring. Collaring is kind of similar sort of thing where I say, okay, I'm extending myself. I'm in a risky position where I'll gain money if I'm right, lose money if I'm wrong, but I'm going to take just enough of the other bet to collar my downside risk. So just imagine I say, okay, my risk is this. I'm going to draw a line, place another bet that says, but it can't go below this number because I just bought another contract that says if it does go below that number, I make money. Right. So that's perfectly legitimate, right? I just said, okay, I'm willing to risk from here to here, but beyond that, I'm buying the contra position. So I start making money there. And so I'll make less of a return, but I'm also taking on less risk. And again, that's a very simple illustration, but like you have to really picture, I mean, this is like saying this is like saying that what Google does is it reads through the internet to find the letters you're typing in. I mean, we have to understand like how vast these server farms are at this point. How complex these high frequency trading platforms and derivatives platforms are. We're talking tens of trillions of dollars, by some accounts, hundreds of trillions of dollars in derivatives trades outstanding. I mean, just mind-boggling amounts of bets and trades happening all the time. And what we're seeing here is, frankly, they got caught with their pants down. They didn't collar their downside risk. They didn't draw that line and say, okay, but if the price for whatever reason, I mean, GameStop's dying, but if their stock goes above 100%, I'm taking the contra position there. That was what they should have. If I were their boss yelling at them, that's what I'd be saying. It's like, you guys took an uncollared position with absolutely no limit. Like that's, you guys have bent us over.
I don't understand how they didn't see this coming though. These guys all work 16-hour days in their office, staring at computer screens. This was people posting about this on Wall Street Bets on Reddit for months. For years, they've been pumping and dumping stocks. How did they not see this coming? Like, if I was a client of one of these hedge funds, which I never would be because I'll never have that much money.
Yeah.
But like these hedge funds are made up of people's pensions. They're made up of people's 401ks.
Right.
It's good. It's easy to say, oh, fuck the hedge fund managers. But at the end of the day, like, this is going to affect real people, even though it does feel good to see, these hedge fund managers kind of get kicked in the teeth.
Was that a question? Yeah, no, that's exactly what's happening. They got arrogant, they got greedy, and they didn't take the safe play. They extended themselves because there's that thing in, God, it's probably a terrible analogy, but it kind of works. Picture the U.S. Navy. They're looking for like certain types of threats. They're looking for Russian and Chinese submarines and all this stuff. But like then someone flies a plane into a building. There's always going to be, in the Pentagon they talk a lot about asymmetric warfare. Wall Street just got hit with an asymmetric attack. It didn't look like what anyone in the professional room was expecting. Everyone in the war room was like, okay, they've got. I mean, picture all these guys in there with just a room full of monitors. This is all they do. But this is what's called a black swan event. It's just there's never been one before, and now it's here, and now that just happened. Yeah, these things happen periodically, and it's just you're still dealing with human beings. Ultimately, like for all the talk about algorithms and artificial intelligence platforms in trading, a person could have made a different call here, and they, for whatever reason, they didn't. And I think it's just, it's the David and Goliath thing, right? You have absolutely no concept that you could lose this fight, and so you're just not. You get careless.
So before we start wrapping up,
Yep.
what do you see happening in the future in terms of regulation or changes? You know, because obviously the people that's happened to are not going to want to see it happen again.
So this is interesting. So there's all these different vested interests, right? And ultimately, like, the cynical take is like, well, they're all there to make money, so they're all going to want to keep making money. So there's a lot of players who want this thing to kind of go in the rearview mirror and tell people not to worry. One, you'll see traders doing what I'm kind of talking about and having probably tighter collars on these things when you're going into kind of these kind of short positions. You may see them kind of collaring their upside risk more and more, and probably watching some of the chatter on social media to see if there's any one of these bubbling. They're not hard to spot. I mean, Reddit's public. You know, this was not this is not a conspiracy. They could have just gone to Reddit and
there was a
happening.
Market Watch. I think there was a Market Watch article last year about a hedge fund that bragged about trolling Wall Street bets on Reddit just to counter them. So it's just crazy, man. They didn't see this coming.
Do you remember in The Social Network when they dragged Mark Zuckerberg in front of the Harvard board? You guys remember this?
No, I didn't see them.
And they're like, you took down the network, you did this. It was actually a good metaphor for this. They're like, you took down the network, you did all this awful stuff, you're being charged as a student. And he's like, well, I think I deserve some recognition because I actually pointed out some vulnerabilities in your system. And then, the kind of IT admin kind of bristles at him and says, son, this is a very complicated network. It's how we were able to find you and track you down in like 4 hours. And he kind of smirks at them and it's like, if you knew what you were looking for, you'd have seen the formula written on my dorm room window. Like, it was right there in front of everyone. You just didn't know where to look. And that's kind of how I take this. It's just they didn't know where to look. And the biggest takeaway, regulatory stuff aside, the biggest takeaway is now they know where to look to not only keep a lid on these things in the future and for the professional firms to protect themselves, but they also know where to go for. I think what you're going to find is that these things keep happening, but now Wall Street firms are along for the ride, and they'll be betting with them and against them. And then, like everything, these things just kind of get wrapped up into the big. This is just another new tool in the toolkit of Wall Street at this point. I expect it'll be that combined with some sort of regulatory language, which if I had to make a prediction, I would expect that at some point in the not too distant future, there's you guys know how they do this, right? They don't just come out and say Reddit can't make money in the stock market. What they say is that, well, to kind of protect people's investments and reduce volatility, which doesn't lead to price discovery, we're going to reinterpret some of our existing guidelines, that sort of thing, such that we're not going to allow these social media based runs. So I think it would be something like if there's chatter kind of with people clearly publicly stating that they're going to drive the price of a stock higher to push shorts out of it, I think they'll find some way to say, like, okay, then the regulator gets to step in and cry foul and throw a yellow flag on the field and stop the play, right? Like, maybe they'll do that, maybe they won't. I think it'll be some combination. It'll be the regulators will do some reinterpretation, and I think Wall Street firms, I think the short sellers will just collar their risk a lot more carefully going forward. And I think you'll get other firms that are like, oh, this is great. I'm going to ride the rocket. I'm going to figure out how to listen to the chatter. I mean, some of them are already doing this. I think you'll find the institutional people start paying a bit more attention.
So one last question in the chat, and then I personally got to go, but you and Seth can keep going. Obviously, the short squeeze, the artificial pumping of the stock, they can't go on forever. If the short sellers just keep holding these positions until it goes back down to $10, have they really lost anything? Other than the payment for the privilege of borrowing and selling.
That's the thing that's almost certainly not going to happen. Where the stock crashes is after all these options expire. But imagine you've got all these guys lined up against the wall, dead to rights. You're not just going to kind of they're going to hit them with everything they've got until those things expire. Once all these, consider these options, these short positions, consider them the current toxic assets. They're holding these just bags of shit, and they can't do anything about them. They can't pawn them off on somebody else. They're stuck holding these bags, and they're going to have to pay out if anyone, to keep the legitimacy of the game going.
But unlike other short squeezes where it's one firm putting all the pressure on, this is thousands of people on the internet. They're gonna break eventually. They're gonna start selling, and that's gonna cause a cascade.
But I'm saying they're only pumping money into the stock because you have these contracts, these short contracts that are going out like 30 or 60 days. I'm saying once those things have passed, right? No one's buying shorts on GameStop right now. Actually, that's not true, obviously. But like the big staked positions that people are taking advantage of punishing right now, they're not going to renew those positions. The moment those, like whatever the stock price is on the day that thing expires, they're going to have to pay out that difference. And then that'll be the end of it. And I would expect the stock to kind of revert back down to whatever it was.
Is there any way for the funds to renegotiate or extend those contract dates? Or do you think that the stock is going to stay inflated all through the next 30, 60 days or so?
No, a contract is a contract. Like you typically enter into
you
that
can
for
modify
like
it.
30 days,
Contract's
right?
an asset here. Yeah. Yeah.
And so that brings in
that.
another interesting point, which we haven't really talked about, is micro trades, right? So you could buy a 30-day contract and sell it, 4 hours later, right?
Sure.
So
Right.
so the opportunity for manipulation within the length of the contract is, how fast can you sell it?
I'll put this, and I want people to note the ominous tone here. I'm not making a prediction. I'm just kind of telling you what the lay of the land is right now. The price today is like 250, right? So the simple math is that all the people who own those short contracts have to pay out the difference, right? Whatever they bought it at, like $30, right? So imagining it's going to go to 20. Instead of pocketing 30 minus 20 is plus 10, instead their math is 250, 30 minus 250 is minus 220. That's what they're paying out per share to these people. So here's the ominous thing that I'll just leave people with. That's what the price at 250. What Wall Street Bets has noticed is that, guys, what if the price went to 1,000? What if it went to 5,000? Then they'd have to pay out 30 minus 5,000 per share. And that's why they suspended trading today. Because everyone's kind of looking at this and saying, well, so if people just buy the stock, these guys have to keep paying out to infinity. And that's kind of where everyone's kind of looking around and looking at each other and like, so what do we do now? And Reddit's answer is, buy the fucking stock. And Wall Street's answer is, maybe we should just kind of call it a day. So that's kind of where we are. And basically Wall Street got caught with their pants down. But there's, because those contracts haven't expired yet. It's not like people, I bet the wrong way and now it's over. It's like, no, my bet doesn't end until like 30 days from now. And if I'm holding those contracts and I've agreed to buy the stock at the market price 30 days from now, I'm sweating bullets because there's no reason it has to stay at 250, and they can't stop people from buying a publicly traded stock for a month. So if Reddit gets all these crypto people, here's the nuclear bomb. Imagine you got the crypto people being like, let's sell cryptos and buy GameStop, drive the price to 5,000. That's why this is such a big story, and why everyone's why the professionals are kind of looking at each other nervously, like, oh God, like that's what the contract says.
Wow.
So we'll see what happens. Not a prediction, but that's it's going to be interesting. It's not over yet at all.
Wow. So to recap, basically, the super rich hedge fund managers are able to leverage everything in order to screw the retail investors, even when those retail investors get a leg up. Fantastic. Nothing changes.
Oh yeah. What did you think this was? It's I do picture Casino, with the guy like getting hit with the hammer, like that. That's kind of, this is not like, and again, this is why I roll my eyes whenever someone brings up the free market. Like you're talking about traders. They'll take any advantage they can. Like it's like playing Monopoly against, someone whose only goal is to win. So yeah, like we will see how this plays out. But this is a new type of populist investing.
Do you think it's going to happen again?
Absolutely.
Oh yeah, absolutely. In fact, they're already starting to move. They're moving to Bed Bath and Beyond. They're moving to AMC. I mean, think about these, right? AMC and Bed Bath and Beyond. Would you buy these stocks on their intrinsic value? No. But when you see institutions,
Beyond, I love Bed
Same
Bath
thing.
and Beyond. I
same
love
thing.
Bed Bath and Beyond.
But they've been killed by Bezos. Like, they have no place.
Yeah, Amazon and COVID kind of cleared the table of a lot of these. You want to own Kohl's stock? They're basically a place to return Amazon products right now. Yeah, no, it's the landscape has shifted so radically toward these tech platforms that don't actually need humans for the most part, that can just kind of trade on information. But yeah, there's a lot of what we would call zombie firms. And so basically, it actually, here's a good image for people. You know the concept of like loose nukes, right? You've got these countries like the old Soviet bloc that had these nukes kind of sitting in silos, and then the Cold War ended. But like Russia doesn't own them now. You guys know what I'm talking about? Like the sum of all fears and all
so
that,
like
right?
all of a sudden, like Poland can have like a nuclear weapon.
Right.
Yeah.
So picture all of these stocks that are like GameStop, right? All these zombie firms, they have tens of millions of shares just sitting there. And Wall Street just as part of its ordinary business, right? I mean, it's not like, Wall Street wouldn't exist if they only bet on stocks going up. They're betting they go up and down all over the place. Up, down, sideways, I bet that it stays the same. So they're betting all over the place, and they're now looking, and they're like doing the big, like, they're looking at every one of these zombie firms that they've just been kind of slowly shorting. And they're now looking at the internet being, kind of licking its chops and being like, so we could do this to every single one of them. And as long as the contract for the short position exists, I can just bet that it's going to go up and then expect people to kind of jump in there and do the same thing. It really, the image I like as kind of a database guy is that like, this is like a distributed denial of service attack, like a DDoS attack where like, you didn't get the people's password to get in there. All you did is just bombard the network with requests until it basically shuts down. That's what I meant by the Zergling thing, right? You just rush with a lot of units, and then the big powerful thing doesn't know what to do, so it just kind of falls over. That's kind of what happened here in a weird way. But yeah, it's very much an active story, and I'm glad you guys did this emergency podcast thing. I think it's great people get some sense of what's going on because it's fascinating. It's like, to me, it's like watching the Arab Spring or something. Like what Twitter was doing. Suddenly these guys can talk to each other. And just like the people with guns can talk to each other. That's kind of the new world we're living in. And frankly, these models were perfected long before there was really the expectation that you could get cohesive movement and strategizing among random people on the network, which is what's starting to happen right now. So in some ways it's scary, in other ways I'm absolutely delighted and thrilled. It's a mixed bag. It's a new type of kind of conducting these things.
Yeah, it is really interesting, and we really didn't even get into the real social aspects of what's going on here, and those are the parts that I find most interesting. So maybe we can do a follow-up next week when when everything is completely crashed.
If anyone's curious, Dogecoin is up 384% today. Again, not investment advice.
Nothing means anything.
Yeah.
They're my favorite one because they were set up to make a joke about how these cryptos have no intrinsic value. Like, I got an idea for a crypto. How about I put a Shiba Inu on it and sell it? And they raised like $100 million. Just astonishing. It's like it's just beyond parity. It was the same. Actually, here's a fun little. Yep.
I mean, yeah. I mean, people are going to believe what they believe, right? And so the belief in your currency is what gives it value, whether or not it's intrinsic. Doesn't really matter at that point.
Well, that's why it says in your dollar bills in your wallet, promise to pay rather than value. Just a promise to pay. It doesn't have any value in and of itself except what other people will give you on the other end of the transaction. And yeah, that's probably the big takeaway for people is that, like, let's be very clear on what money is versus what value is. versus what's good for the economy. And these things don't necessarily, as we're finding out in this case, don't necessarily have anything to do with each other. But because they all kind of get talked about in the same soup of finance, economics, politics, people kind of get a sense of how it all works. But then when you get one of these at the margin where it's really kind of testing, well, what do you mean by a contract? What do you mean by currency versus, et cetera? In those details, there are these plays to be made. And I think this was that like Wall Street thought they had the game mastered, and then someone came out with a trick play and it worked. And I expect them to keep running it on different stocks until collusion between the Wall Street firms and regulatory intervention kind of puts a lid on it. And I actually do expect that to happen. But the funny thing to watch for will be how they do it. When they do announce something, like just watch the language they use about why it's so essential we do this. They're not going to say, we don't want people on Reddit to make money in the stock market. It'll be something more about preserving transparency and, faith in markets and all that stuff. But basically, like, yeah, you basically have a hedge fund that, like, you think of this hedge fund, Melvin, as like a piñata, and Reddit just put a pickaxe through the thing and it's just now spewing money. And basically, I'm not giving advice, but like those contracts are still there, and they can't just declare that they're not now. And so, yeah, the next few weeks are going to be fascinating. We are in uncharted waters, and it's, my attitude is like, anyone's political leanings aside, like just in terms of anthropology, this is something new and different, and therefore very interesting.
Certainly it is. Awesome. Yeah. So, can we find you, follow you anywhere? This is typically kind of the thing we do at the end of the show is to make sure that you have a lot of stalkers.
I'm hard the other side. I tend to keep a fairly low profile. I'm working on kind of a personal stealth startup thing right now, so I'm actually pretty quiet about that stuff. But I'm happy to chat with you guys whenever.
Oh, okay. Well, good for you. And yeah, I think we definitely need to have you back because I think we have a couple of hours of unanswered questions here.
There's a lot here, and we did do the thing where like half of this should have been just documented preamble, but we kept kind of so yeah, like there's more to dissect here. But yeah, I'd be happy to chat more about this or anything else. The economy's fascinating. It is just this never-ending arms race. It's very much kind of an evolutionary process. So it's very, very interesting. What's that?
The South Park episode, Margaritaville, where they have to like sacrifice things to the economy.
I don't know South Park as well, but I know a bit about Matt and Trey, and like, yeah, that sounds about right. It is the cow god Moloch. This is that's kind of what they're talking about. Yeah, like this is something human civilizations have warned about, like long since before the tulip thing. Like this goes back to kind of Old Testament stuff, right? Like you start worshiping the golden god and believing that it's going to redeem you, and then society does that too long, and eventually reality just comes up and smacks them on the side of the head. And like, yeah, that was delusional. That wasn't real value. You guys just convinced yourselves it was. And we're definitely headed for that in the housing market. But this was one of those kind of interesting, funny. I think that was the thing. Is ultimately it's that it's funny. It's not like this is even a huge amount of money by Wall Street standards. It's just that it's so kind of lovably adorable that they pulled it off. There's a lot of people who don't see the humor in it right now, like sending a lot of very angry and threatening emails. So we'll see how that all shakes out.
Good stuff. All right, well, I think that's about all I've got. And we'll definitely
this was great, guys. Thank you for having me on.
Yeah, thanks
a lot. This was actually really fun. I appreciate you joining us, and I'm going to do our obligatory 30-second plug. Make sure you follow us on Facebook and Twitter, and come over to the forums at bullsheeto.net and join the conversation. We can talk more about this, and we will be putting this episode up on all the usual stuff. It'll be on the homepage and everything else. So thanks very much, Andy. Thanks, Derek, for this evening. I have been your completely incompetent host, Sub Messenger, and we will catch you on the next episode.